$1.5 trillion is not just another number buried in financial reports that almost no one reads. It is a wall of commercial real estate debt packed into imminent maturities, ready to collide with a financial system that is already operating at the edge of fragility. This massive volume of contracts comes due primarily between 2026 and 2027, creating a bottleneck that cannot be kicked down the road indefinitely. This is not a distant hypothesis or an abstract risk. The maturities are signed, sealed, and recorded. The only open variable is who will absorb the losses. When people hear real estate collapse, most still instinctively think of residential homes and delinquent families. That is a fatal misread. The epicenter of the next crisis is not in the suburbs, but in the financial cores of major cities. We are talking about office towers, shopping malls, hotels, logistics warehouses, and large commercial complexes valued in the billions during the era of free money. These assets were acquired under the assumption that low interest rates were permanent and that growth was guaranteed. That assumption is dead. For more than a decade, the system was conditioned to operate under artificially near-zero rates. This completely distorted risk perception. Projects that would never be viable in a normal environment appeared sound simply because the cost of money was irrelevant. Developers leveraged aggressively, banks loosened credit standards, and investors accepted ever lower returns, believing the Fed would always step in to save the game. That mindset created a silent bubble, less visible than 2008, but potentially far more dangerous. The structural problem of commercial real estate debt lies in its very design. Unlike 30-year residential mortgages, these loans mature in short cycles. 5, 7, or 10 years later, the balloon payment arrives. There is no emotional negotiation with mathematics. Either the owner refinances the debt or loses the asset. For years, refinancing was trivial. You rolled the loan, pulled out more capital, and moved on. Today, that mechanism simply no longer works. Refinancing in 2026 means accepting rates 2, 3, or even 4 times higher than those originally contracted. At the same time, property income has not kept pace. Offices remain empty, remote work has solidified, malls have lost structural foot traffic, and hotels operate under compressed margins. Maintenance costs, taxes, and insurance have exploded. The cash flow that once supported these structures has evaporated. In thousands of cases, the property does not generate enough income to cover even interest payments, let alone principal. That is why we are witnessing something that seemed unthinkable just a few years ago: billionaire owners simply handing assets back to banks. Not because they are bankrupt, but because continuing would be irrational. When the debt exceeds the asset's value and there is no realistic recovery path, the logical decision is to walk away. This is already happening at scale, even if it remains far from mainstream headlines. Major global managers such as Blackstone, Brookfield, and PIMCO have already recognized multi-billion-dollar losses in commercial real estate. These are not amateur investors. They are the most sophisticated institutions on the planet, with privileged access to capital, information, and political influence. If even they are accepting losses and returning keys, it should be interpreted as a clear signal that the problem is systemic, not isolated. The common mistake is to believe these cases are exceptions. In reality, they are only the first wave. Those truly bearing the weight of this crisis are not global funds, but U.S. regional banks. Roughly 70% of commercial real estate debt is concentrated in these smaller institutions, which finance local projects and depend directly on the economic health of their regions. These banks lack the diversification of large financial conglomerates and do not have easy access to unlimited liquidity lines. They are simultaneously the most exposed and the least prepared. Regional banks are the heart of the real American economy. They hold the deposits of small and mid-sized businesses, payroll accounts, agricultural credit, and local financing. When a large commercial real estate loan goes bad, the impact does not remain confined to a balance sheet. It spreads across the entire city. The bank becomes the owner of an empty building it cannot operate or sell without massive losses. Banks are not developers. They do not know how to manage properties, renegotiate leases, or revitalize urban centers. The only option is to sell, and when multiple banks attempt to sell similar assets at the same time, prices collapse. That price decline destroys the collateral value of other loans, creating a chain reaction. A property sold at a 40% discount resets market values across an entire district, forcing negative revaluations and new accounting losses. This process dangerously resembles the savings and loan crisis of the 1980s, but on a far larger scale and within a vastly more leveraged system. Back then, the problem was contained at enormous cost to taxpayers. Today, the room for maneuver is far smaller, the government already runs trillion-dollar deficits, and institutional trust is fragile. There is neither the political nor fiscal capital to repeat a broad rescue without severe consequences. Many believe the FDIC acts as an absolute shield against this kind of crisis. That confidence is misplaced. The Deposit Insurance Fund holds just over $100 billion to protect a system with trillions in deposits. That mechanism works for isolated failures, not systemic collapses. When multiple banks come under stress simultaneously, the fund is clearly insufficient. The most overlooked detail is that since the 2008 crisis, U.S. law allows bail-in mechanisms. This means that under certain circumstances, deposits above the insured limit can be converted into equity to recapitalize failing banks. This is not speculation or conspiracy theory, it is written into law. In a deep commercial real estate crisis, depositors become unsecured creditors exposed to real losses. The contagion does not stop with traditional banks. Pension funds, insurance companies, and private credit vehicles are deeply involved in this market. Many promised frequent liquidity while purchasing inherently illiquid assets. That structural mismatch works only as long as no one asks for their money back. When redemptions begin, the structure collapses quickly. Private credit, which has grown explosively over the past decade, is particularly vulnerable. These funds operate outside the traditional banking system, with less transparency and oversight. They lent aggressively to real estate projects precisely as banks began pulling back. Now they face rising defaults without a central bank willing to rescue them directly. When the first forced sale occurs within such a fund, the price becomes public. Valuations fall in cascades, margin calls explode. Highly leveraged structures collapse. This is the subprime of the new decade, not with single-family homes, but with skyscrapers and commercial centers. The scale is different, but the logic is identical. The Federal Reserve is trapped in a dilemma with no clean exit. Cutting rates too early reignites inflation and destroys currency credibility. Keeping rates high for too long accelerates bank failures and real estate collapse. There is no soft landing when massive contracts mature without sufficient cash flow. Monetary policy has lost effectiveness in the face of a structural solvency problem. Even if the Fed begins cutting rates tomorrow, it doesn't solve the core issue. The rates required to refinance these properties would still be too high relative to the income they generate. Moreover, aggressive cuts would signal panic, pressure the dollar, and reignite inflationary forces. The Fed is choosing between two bad outcomes, attempting to select the less destructive one. The social consequences of this collapse are deep and underestimated. When commercial properties lose value, city tax bases evaporate. Municipalities collect less revenue, cut services, raise taxes, and drive businesses away. A cycle of urban decay sets in quickly. Once vibrant centers become financial deserts, with empty buildings, rising crime, and population flight. This process is already visible in several major U.S. cities. Financial districts with record vacancy rates coexist with growing fiscal deficits. Companies reduce physical footprints, restaurants close, jobs disappear. Even those who never invested in real estate feel the impact directly through higher living costs, tighter credit, and job instability. The uncomfortable truth is that wealth is not destroyed in these cycles. It is transferred. Assets change hands when panic meets liquidity. The leveraged lose, those with cash buy. This has always been the case. What is different now is the scale and the speed. We are entering a buyer's market that appears once per generation, but only for those who did not believe comforting narratives. This type of transition never unfolds in an orderly manner. First comes denial, then minimization, followed by surprise, and finally panic. The system is currently in the middle phase, where the signs are obvious to those willing to see them, but ignored by the majority. When perception finally shifts, it will be too late to react. The collapse of the commercial real estate market is not an alarmist prediction or an exercise in pessimism. It is contractual mathematics. The maturities are fixed, the money is unavailable, and the system lacks sufficient shock absorbers. The machinery has already begun to move. Each passing month reduces options and increases pressure. Those who understand this shift before panic sets in do not stand in the losers' line. They adjust expectations, reduce leverage, and preserve liquidity. The financial system does not warn before it breaks. It simply breaks. And when it does, the rules change overnight. The next domino is not a question of if, it is only a question of when. And when it falls, the sound will be heard far beyond the real estate market.